In this video, we will show you 7 high-quality stocks to own for the next decade and beyond. What you are about to hear is a carefully thought-out, long-term investing framework built around companies that sit at the core of global systems and are positioned to compound value through multiple economic cycles. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you do not miss out on the next important financial investing update. Let us begin with the first company on the list. Brookfield Corporation, ticker symbol BN. Brookfield is one of the most important long-term investment vehicles in the global financial system, yet many investors still misunderstand what this business actually does. Brookfield is not a traditional operating company. It is a global capital allocator and asset manager that specializes in owning and operating long-duration real assets. These assets include infrastructure, renewable power, real estate, private equity, and credit. What makes Brookfield unique is not just the types of assets it owns, but how it owns them. Brookfield focuses on assets that generate steady cash flows over decades and are essential to economic activity. Think power grids, pipelines, data centers, ports, toll roads, and utilities. This business matters because the world runs on physical infrastructure, and much of that infrastructure is aging, underinvested, or mismanaged. Governments and institutions around the world increasingly rely on private capital and experienced operators to modernize these assets. Brookfield sits right at that intersection. One of Brookfield's strongest competitive advantages is its access to capital. Institutional investors trust Brookfield with massive pools of money because of its long track record and disciplined investment approach. That allows Brookfield to deploy capital during periods of stress when others are forced to pull back. Brookfield also benefits from powerful structural tailwinds. The global transition toward renewable energy, the explosion of digital infrastructure demand, and the need for resilient supply chains all directly support Brookfield's investment strategy. These are not short-term trends, they are multi-decade shifts. From a financial standpoint, Brookfield generates value through multiple channels. It earns recurring fee-related earnings from managing assets for clients, while also benefiting from ownership stakes that generate distributions and long-term appreciation. This layered model creates resilience and flexibility. Recent financial updates continue to show Brookfield executing on its long-term plan. The company has remained active in capital deployment while maintaining balance sheet discipline. Management consistently emphasizes long-term value creation rather than reacting to short-term market noise. Brookfield is a stock designed for investors who think in decades, not quarters. If you believe the world will continue to need infrastructure, power, and real assets, Brookfield offers exposure through one of the most sophisticated operators in the world. This video is brought to you by Value Stocks Investing Master Course. If you are looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Next on the list is Enterprise Products Partners, ticker symbol EPD. Enterprise Products Partners is one of the most critical energy infrastructure companies in North America, yet it operates almost entirely behind the scenes. This business owns and operates pipelines, storage facilities, processing plants, and export terminals that move energy products through the economy. What makes Enterprise so compelling as a long-term holding is its business model. The majority of its revenue comes from fee-based contracts rather than direct exposure to commodity prices. That means Enterprise gets paid for moving and processing energy regardless of whether prices are high or low. This stability is incredibly valuable in an industry often associated with volatility. Enterprise focuses on volume, reliability, and long-term contracts rather than speculation. Energy infrastructure remains essential to modern life. Even as renewable energy grows, hydrocarbons continue to play a central role in transportation, manufacturing, heating, and chemicals. Enterprise's assets are deeply embedded in this reality. Another major growth driver for Enterprise is global energy exports. The United States has become a key supplier of energy products to the world, and Enterprise's infrastructure is critical to that process. Export demand creates a long runway for utilization and cash flow growth. From a financial perspective, Enterprise has maintained one of the strongest balance sheets in the midstream sector. Management prioritizes conservative leverage, steady cash flow, and sustainable distributions. That discipline is exactly what long-term investors should look for. Enterprise is not designed to excite traders. It is designed to quietly generate cash, survive downturns, and reward patience. Over a decade or longer, that combination can be incredibly powerful. The third company on the list is MicroStrategy, ticker symbol MSTR. MicroStrategy is one of the most unconventional companies you will ever analyze, and that is exactly why it belongs on this list. At its core, MicroStrategy is an enterprise analytics and business intelligence software company that helps organizations analyze data and make better decisions. That business alone gives MicroStrategy relevance in a world increasingly driven by data, but the company has layered an entirely different strategic dimension on top of its operating business. MicroStrategy has made a deliberate decision to allocate a significant portion of its balance sheet to Bitcoin. This has effectively transformed the company into a publicly traded vehicle that combines an operating software business with a digital asset treasury strategy. This matters because it represents a new way of thinking about corporate capital allocation. MicroStrategy's leadership views Bitcoin as a long-term store of value in a world of currency debasement, rising debt, and monetary expansion. Financially, this creates volatility, but it also creates asymmetry. When Bitcoin rises, MicroStrategy's balance sheet strengthens significantly. At the same time, the underlying software business continues to generate revenue and serve enterprise clients. Recent financial updates show that MicroStrategy remains deeply committed to this strategy, continuing to manage its debt and capital structure around its long-term view. This is not a passive decision, it is a conviction-driven approach. MicroStrategy is not suitable for every investor. It requires an understanding of volatility and risk tolerance. But for investors who believe in digital scarcity and want exposure through a public company with an operating business, MicroStrategy offers something unique. Over the next decade, MicroStrategy will likely be remembered as one of the most interesting capital allocation experiments in corporate history. The third company on the list is MicroStrategy, ticker symbol MSTR. MicroStrategy is one of the most unconventional companies you will ever analyze, and that is exactly why it belongs on this list. At its core, MicroStrategy is an enterprise analytics and business intelligence software company that helps organizations analyze data and make better decisions. That business alone gives MicroStrategy relevance in a world increasingly driven by data. But the company has layered an entirely different strategic dimension on top of its operating business. MicroStrategy has made a deliberate decision to allocate a significant portion of its balance sheet to Bitcoin. This has effectively transformed the company into a publicly traded vehicle that combines an operating software business with a digital asset treasury strategy. Next is Canadian Natural Resources, ticker symbol CNQ. Canadian Natural Resources is one of the most disciplined and resilient energy producers in North America. The company focuses on long-life, low-decline assets that generate cash flow across commodity cycles. This business matters because energy production remains essential to global economic growth. Canadian Natural Resources has built a portfolio that allows it to operate profitably through both strong and weak pricing environments. One of its biggest advantages is asset longevity. Many of its projects have production lives measured in decades. This allows the company to plan capital spending conservatively and focus on efficiency rather than constant replacement. Management has also been highly focused on shareholder returns. During periods of strong cash flow, Canadian Natural Resources has prioritized dividends and share buybacks while maintaining balance sheet strength. From a long-term perspective, global energy demand continues to rise, particularly in emerging markets. Even as renewable energy adoption increases, oil and gas remain critical to transportation, manufacturing, and infrastructure development. Canadian Natural Resources is positioned as a reliable supplier with a focus on operational excellence. That combination makes it a durable holding for investors looking beyond short-term energy price cycles. The fifth company on the list is CVS Health, ticker symbol CVS. CVS Health is not just a pharmacy chain, it is a vertically integrated healthcare platform that spans retail pharmacies, pharmacy benefits management, health insurance, and clinical services. This business matters because healthcare is one of the largest and most complex sectors of the economy. CVS operates across multiple layers of that system, giving it scale and influence that few companies can match. By integrating insurance, pharmacy benefits, and physical locations, CVS can manage costs, improve patient outcomes, and create efficiencies that standalone players cannot replicate. This integration creates a powerful moat. Recent strategic initiatives have focused on expanding healthcare services, improving digital capabilities, and streamlining operations. CVS continues to adapt to regulatory changes and reimbursement pressures while maintaining strong cash flow. Demographic trends also strongly support CVS's long-term outlook. Aging populations and rising healthcare utilization create durable demand for the services CVS provides. CVS may not look like a traditional growth stock, but it is a technology-enabled healthcare platform built to compound value over time. For patient investors, that combination can be very rewarding. Next is Intercontinental Exchange, ticker symbol ICE. Intercontinental Exchange operates some of the most important financial exchanges and data platforms in the world. These markets facilitate the trading, clearing, and settlement of financial and commodity contracts across the global economy. What makes ICE so attractive as a long-term investment is that it benefits from complexity. As markets become more regulated, data-driven, and interconnected, the need for reliable exchanges and data infrastructure increases. ICE generates revenue from trading activity, clearing services, and data subscriptions. This diversified revenue model provides resilience across market cycles. The company has also expanded into mortgage technology and data services, embedding itself even deeper into financial workflows. These systems are mission-critical for clients and difficult to replace. Financially, ICE has demonstrated consistent margins, strong cash flow, and disciplined capital allocation. Management focuses on long-term value creation rather than chasing short-lived trends. Owning ICE is like owning a toll booth on global markets. As long as capital flows, ICE collects fees. Over a decade or longer, that is a very powerful position. The final company on the list is HDFC Bank, ticker symbol HDB. HDFC Bank is one of the largest and most respected private sector banks in India. It operates in an economy with strong demographic tailwinds, rising incomes, and increasing financial inclusion. This business matters because banking is foundational to economic development. HDFC Bank has built a reputation for conservative risk management, strong asset quality, and consistent growth. India's financial system is modernizing rapidly, with increased digital adoption and formalization of economic activity. HDFC Bank has been at the forefront of this shift, leveraging technology to expand efficiently. Recent developments include integration efforts following corporate restructuring and continued expansion in retail and commercial lending. While short-term challenges exist, the long-term growth story remains compelling. HDFC Bank benefits from scale, brand trust, and a large deposit base. These advantages allow it to grow responsibly while maintaining stability. For investors seeking long-term exposure to emerging market growth with strong governance and discipline, HDFC Bank stands out. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now here is a question for you. Which of these 7 businesses do you believe has the strongest long-term competitive advantage and why? Let me know your reasoning in the comments. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.